Come on,
Yo,
tell me we don't have the best intro music in the financial podcast game.
I wish I could freestyle. I wish I could just like come in and like just hit that hard. I'm also really glad that they like it doesn't show our video while that intro is playing because I'm just like vibing, you know?
I was dancing too, but I couldn't see you, so I was just I see what everybody else sees, so I was dancing away too, so I couldn't see you dancing. Welcome to Pirates of Finance, where we go live every Friday at 3 p.m. Eastern. This show is for informational and entertainment purposes only, not educational. So please, seek out your own financial advisors. Nothing we say is investment advice. We hope to at least be entertaining. If you don't like two giant egos that like just talking about themselves, then this isn't the show for you either. And we just ramble in a solipsistic fashion, and that's what we do. So with that interlude,
I see you've been reading the comments.
That's what you should
You
never
took
do.
a trip to Goblin Town and have been. I gotta center my. There we go. You've been I messed that up. You've been reading the comments for sure. Before we get started, by the way, our good buddy Chris Abdumasala is going live with our good friends at Resolve Riffs in an hour.
We got to end early. We got to end early today.
I'm going to tell you right now, whether I'm mid-sentence or you're mid-sentence, at 3:59 and 59 seconds, I'm just gone. I'm gone.
There you go.
No outro.
As we know, Chris is a phenomenal options trader that's recently retired, good friend of the show, and so yeah, I'm really looking forward to that Resolve Riffs, and I'm glad Chris is now willing to step in front of the camera. By the way, I think we broke him. I think we were the first on our old Pirates of Finance channel.
On the old channel, I've tried to get him on my podcast to do like a deep options dive, and he's just too humble. He just doesn't think he's worthy, and I don't know how to tell him that anyone who fogs a mirror is worthy of being on my podcast.
That's a good one. I always think about too, like, so part of that and why I'm always talking to Chris to do more appearances is like whether we like it or not, we're in the world of personal branding. And whether that's good or bad, we're not saying any of that, whether it's positive or negative, all those things is like you just have to kind of admit the state of play and where we are. And part of that, I think the transition, thinking about the world in that way also translates well to NFTs or PFPs. And just thinking about not only personal branding, but like company and community branding, and how do you build a tribe out of like-minded people in the digital space, or what we, metaverse light space, let's call it, that we live in this digital realm with people around the world. So we, you and I have a fascination with the entire NFT space and crypto in general. So let's kind of go down that rabbit hole a little bit, because there's been some really interesting projects that you and I have been texting about throughout the week. So I'll let you kind of kick it off with the nada or wherever you would like to start.
Yeah, first, can we hit rewind and replay that little segue you did there? It was nice. Nice way to worm your way into NFTs. I want to give you a little golf clap for that one. Yeah, look, I mean, 2 big NFT launches in the last sort of 7 days, right? You had Moonbirds, which I think you've been tracking more closely than I have. Kevin Rose's project, yep. I believe that is, though he's teamed up with folks like Gary Vee and other big influencers that are all a part of this group that pushed these out. I mean, they went from I think sub $10,000 to north of $100,000 at floor value within 3 or 4 days, creating tons of trading volume and an initial treasury for the project north of 75 million, if I'm not mistaken. And then I've got a couple good friends, anonymous crypto gentlemen, Grug Capital, Big D, and DCF God. It feels ridiculous saying these names, who have been working on this project called Anata. And Anata is actually pretty cool in my opinion. It's for VTubers who don't want to show their face. It's a whole rigging system where the camera overlays. They chose to make them sort of anime characters. And it's got these really cool features. So it's not this PFP. It's you own this rigging system and you can use it for Zoom or Twitch or even something like this. And they're really great looking. I know they put in $250,000 to have them made. And they just ran a auction-based minting system over the last 24 hours. And the idea was basically they're auctioning away 1,920 of them, if I'm not mistaken, and everyone could enter their sort of auction, and then they would basically find the bid that was the 1,920th, and everyone who bid above that got the Anata, but at that minimum bid price. So if you bid 100 and the minimum bid price ended up being, say, 5, you would only pay 5. But you were sort of guaranteeing yourself in by saying, I'm willing to pay 100 if the min bid goes up to that level. So
what would you call that auction style? Because I was going to bring that up with you. Auctions, Dutch auctions, etc. But this is like a min max bid. Like, what would you call it?
That's a good question. I don't know what this is.
I like that, though.
Called. It has a name. They were saying from their perspective, though, they started the auction at 0.25 ETH. That was like the minimum they would take. And they said a lot of like the dopamine hit is in the last hour, because it's like no one moves off the floor, because once enough people move off the floor, like everyone's sort of trying to collaborate to keep it low, and then they want to fight to get in. So it's sort of like this crazy last hour. The other thing they did is they didn't define when it was going to end. So they said it's going to run for 24 hours and could end randomly anytime in the last 3 hours. So it prevented that sort of like very last minute sniping that can happen, because it was like you might think it's going to end in an hour and it actually ends in 2 seconds and you just aren't aware. So they tried to introduce a little bit of randomness that made it harder to game. My big point here, though, is good buddies of mine, just from the mint alone, the total accumulated value of the ETH is $30 million. 50% of it is going to go to the DAO, which where they're planning on doing really interesting stuff. So if you bought an Anata, you're associated now with this DAO that's got $15 million in it. And then there's 3 players who just got $5 million in their pockets each. And there was sort of 2 things that came to mind for me. First, if the minimum bid on these was 5 ETH, which is about $15,000, there is no way that I couldn't just go to Fiverr today and get one of these made for less than $15,000. So there's an interesting aspect here of like either markets are totally irrational or people are massively paying up for being associated with this project and the resaleability potentially of these, right? It's not just, or they believe there's going to be a flip potential for profit, but you see like the true value of it, the replication value. I don't know, you can sort of think of this in like a traditional finance sense of like, what's the book value of these things? I can go out and get one made for far less than 15,000. So that gap between what it can get made for and that 15,000 that was ultimately paid represents a meaningful premium of something, irrationality or brand association, or what they think can be done with the DAO, or the liquidity value of it, that it's not just dead money, you could sell it.
Don't value guys call that goodwill or scuttlebutt, or what do they call it?
Yeah, I don't know, but it's hard to disentangle where it's coming from and whether it's warranted. And then the second part, because while this was going on, and I'm very happy for these guys, I'm having these traditional finance conversations where I'm trying to get a new product out the door. And it takes months and months and months and months to get a new project out the door. And let's say I get this product out the door and it hits scale. It hits $100 million of people allocating. At where you can charge nowadays as a boutique, I might be able to charge 75 basis points. So I would make annually 750,000 in revenue from this.
Yeah, but let's talk about that as gross, though, because like I was just wondering when you were saying that, I wanted you and I to do a show on this, and I'm not sure we can from a compliance perspective. Is like, so most people have no clue, like you're saying, like how much, like $100 million sounds like a lot of money, and it is a lot of money. But in like finance space or managing money, that is a tiny fund, right? Like that doesn't even nobody's even paying attention.
That's a boutique fund,
right? To your point is like, you're making basis points or less than 1% on that, but then you just quoted in the gross, and then now you're not talking about all your service providers and everything. So it's like,
yeah, I don't even want to talk about
net. Yeah, I know. I
don't even want to go there. But I just, again, just sheer revenue. If it gets to 100 million, which is sort of like reasonable scale for a boutique asset manager, you're making 750 grand per year, and it depends, like, what's the revenue multiple on that for the equity value of your business? Maybe 3 to 5, depends how quickly you're growing. Maybe more if it means you can launch similar product and continue to scale that way. But I guess my point at the end of the day is I'm spending months banging my head against the wall trying to get this product out the door, for if it's a success, will make me less than $1 million a year in revenue. And these guys I know just spent 2 or 3 months putting together video chat rigs and just sold it for $30 million in a day. And the crypto valuations are insane. And I am just about ready to, I don't know, besmirch my whatever reputation I have and just go full grift into the NFT space.
Well, I'm glad you're shifted because, as you know, I've been trying to talk you into this for a long time. But also, I was going to transition and talk about, give a little background on Moonbirds too. But before I do, um, maybe this is helpful. Like you're saying about thinking about the space in general. I thought you had a great interview with Lee Drogan from Starkiller that came out on Real Vision. There's even a snippet of it out on YouTube right now. But what I thought was brilliant, or the thing that's made me think about this a lot, especially related to this conversation, is the idea of the boot program as casino that you and Lee were talking about. And it's basically like, if you come from TradFi or traditional finance, and like you said, you're thinking very rationally about what value should be and all those things, is like you entirely miss the space. So is there something between just being like a Chad Laxbro and just YOLOing and being a complete moron, but those are the people that make money, or having some conservative traditional finance, thought process? Is there some sort of in between? And maybe it'll be helpful to me and maybe other non-quants if you can explain boot program to start with.
Yeah, so I want to point out one of the comments that just came in is none of this is English right now. And I 100% agree. Like you start going down this crypto rabbit hole and you have to learn a whole new language. Like what is an NFT? Like I don't think we have time to go into the very basic.
Before you even get into that, speaking of non-English, I forgot. I wanted to ask you, like, what's your burner handle? I'm sure you don't want to tell me, but like, I'm sure you have some crazy.
If I have
handle
a burner handle, I'm definitely not telling you. Certainly not recorded. Yeah. No. So Lee Drogan, Starkiller Capital. Full disclosure, I work with them in sort of an advisory capacity. I think he has this great quote, which is, "The casino is the boot program." And I think very skeptical people look at crypto and say, this is all a grift. It's all gambling. It's all a casino. And Lee's point is that all of these protocols that are being built, sort of all these decentralized apps, require liquidity. And that casino is what's bringing liquidity into the system that will allow these apps to become stable over time. The vast majority probably will get washed away. There's a ton of rapid financial evolution. That things are just getting out competed. They're not making it. There's a lot of grift. All of that is sort of what happens in the wild west of finance. But Lee's point is you sort of need some of that for the rest of this system to bootstrap itself, to get the liquidity in, get the money moving, make protocols so that they can be profitable and eventually become building blocks of the ecosystem. And so I think there is some of this aspect of when you're in early enough and you come from a traditional finance background, you go, this is insane. None of this makes sense. And I'm watching people make millions and millions of dollars on stuff that isn't logical. So this feels like a bubble. And yet on the other hand, you can say there's a lot of hyper intelligent people who have moved to this space that are trying to build really interesting protocols that could have tremendous value in 10 years. And it could just be that, right? It's like the .com days where we massively overpaid to get fiber optic cable everywhere in the world. And the valuation of those companies went to near zero, but the cable got laid and we all benefited from it. So I don't know how this all plays out, but I do like to dabble and keep my fingers on the pulse.
Well, I think there's also like antecedents to this, right? Like I was reading Sebastian Malaby's, history of venture capital, et cetera. And maybe it was in that, or no, it was in the Founders book by Jimmy Soni about PayPal's foundations. And PayPal and then Elon Musk at X at the time were competing with each other to try to get new clients, and they're paying them $25 to $50 a pop to get them to sign up and convince their friends to sign up. So once again, they're going through that bleed and burn, which is very similar to a lot of the way these crypto projects are trying to blitz scale. I mean, that comes out of, that entire concept. I think it was Reid Hoffman talking about blitz scaling is a similar concept, is like, how do you create virality within the system so that way you can, break through gravity, and then you have actual product that can hopefully, kick that door down that you've opened up. Is it rational? I mean, that's a whole different topic of discussion, but I also think there's a lot of nuance here. Like you said, like, are there some really, incredible people building incredible projects in here? Absolutely. Is there absolute scams and rug pulls? Absolutely. But there's nuance. Like I'll say something controversial just to upset everybody. Is like, just once again, there's no black or white. There's always like option C, which is a little bit of both. Is like, take Elon Musk, for example, right? Is he one of the world's greatest entrepreneurs? Yes. Is he also one of the world's greatest frauds? Yes. He's both. Like, he can be both things. And now I just pissed off both sides because they have different feelings about it. But it's
one
like
of your superpowers.
Yeah, exactly. Just annoying everybody. But that is the interesting piece to it. And that's why you and I keep our eye on it. The hardest part, I think, for both you and I is like, as an entrepreneur, I love DAOs, But as somebody that works in finance, like that's a security and you're going to get regulated. Is that like the biggest thing holding you back? Or
It does feel that way. That's the part that scares me. I do feel like when you have dealt with the SEC, you get a huge amount of respect for regulators. And I went through the last decade sort of staring with my mouth open as you just watched Uber and Airbnb just give the middle finger to regulators and get rewarded. Elon Musk has more or less given the middle finger to regulators and gotten away with it. In fact, it's almost gotten to the point where regulators say Elon Musk can disseminate false information publicly because he's known for disseminating false information publicly, right? Like it's just that much of a wild card. And so, yeah, I get scared about the crypto thing. And that's sort of what makes me be very hesitant to get more involved in launching projects, because I do think in many cases they are crossing over the line to being securities. And a lot of people are just going in sort of blissfully ignorant that they're potentially breaking the law. On the other hand, do I think the SEC is going to come down against all of these market participants? I don't. I think this might be a case where financial innovation just outruns regulation, and regulation eventually just sort of says, we're not going to deal with it. So I'm not 100% sure what's going to happen there. But back to your prior point, sort of bootstrapping these businesses, think back to like Google and Google Mail when it first came out. My recollection, and this might be wrong, but my recollection is if you invited people to join Google Mail, the amount of gigabytes you were given in storage went up, right? And so that was a incentive program designed to create sort of like a network effect almost and bring people into the Google program. And that's not that dissimilar to what we see in crypto, where certain protocols are trying to incentivize you to use them, but rather than giving away gigabytes of storage, they're giving away governance tokens. Now, the question is, why should those governance tokens be worth anything? Sometimes I can't answer that with a straight face that they should, but they do seem to have value. And so that can be a way to buy people's participation. And that's actually what you're seeing right now in the NFT space. The biggest platform out there is called OpenSea, and that's where all sort of the secondary market trading used to happen and still primarily happens. But a competitor just popped up called LooksRare, and they are using their own token, the Looks token, to try to invite people and incentivize them to list their security, their NFT on LooksRare, and will pay them to do so right now. And so they're trying to buy the liquidity away from OpenSea. They just started another incentive program in the last couple of days, and they're giving away about $500,000 worth of Looks tokens every single day. And so for someone like me, if I've got an NFT, I can list it and make something like $100 a day on that NFT, just having it listed there. Will it last forever? No. Should they be able to give away $500,000 worth of Looks tokens without impacting the price of Looks? Probably not. But, you know, in the meantime, I guess you keep dancing while the music's playing.
It just makes me think that, like, as we talk about, like, crypto's the Wild West, and part of that is like, man, nature's red in tooth and claw. It's like, it's brutal, right? You can build a great platform and be running, hundreds of millions or billions of dollars through it, and then somebody could just fork your code, airdrop to competitors, and pay you to get on it, and then there goes your entire business. Like, it is. So is as easy as it is to spin something up, it's just as easy to get like your IP stolen and people to be attacking you in various ways. I'm also curious. I don't think I've asked you before. It's like, when I think there's an Ethereum maxi argument that, like with Solana and not having lower gas fees on the minting, is basically they're subsidizing those. Like, if they actually had to pay full gas fees, they'd be much closer to Ethereum, but that's their subsidization process, is on to reduce the gas fees as almost a subsidy for people to participate. Do you think that's fair or no?
I actually haven't heard that argument. So lay that out for me again.
So the argument would be like, other layer 1, layer 2s, like take Solana, for example, is they have the lower gas fees. Now, ideally, they actually would have higher gas fees, but they're incentivizing and they're eating the higher gas fees to just convince people to come over and use Solana instead of Ethereum, if it's for minting NFTs or whatever, because people get upset about the gas fees at Ethereum. And ETH maxis have argued that those, Solana fees would be actually closer to Ethereum, if not higher, if they weren't getting subsidized. So that's the incentive program.
Yeah, I haven't heard that. A lot of these different layer 1s and layer 2s operate on different proof of work versus proof of stake systems that can change
Right.
the gas fees. Congestion changes the gas fees. My recollection is that Solana just works on a totally different validator system. Avalanche works on a totally different validator system than Ethereum, and so the gas fees can be materially different because it's not proof of work. And we would expect that when Ethereum moves to proof of stake, eventually, whenever that happens, the gas fees would come way down as well.
All right, let's talk about Moonbirds as well. So I'll give a quick background. Moonbirds was started by Kevin Rose. If people don't know Kevin Rose, is kind of OG in internet space, was the founder of Dig. Post Dig, Dig was the antecedent to Reddit. He was on the cover of Time magazine, I think, at one point. Like his hat backwards.
That was a long
late
time
90s.
ago.
You remember that one? Like
when was Dig? 2004, 2005?
It might be. I think it's even maybe before that. But anyway, so it goes long history in the space. Then he had like the Foundation show and podcast. He had other things in there. I think at one point he was with Google Ventures. Then he helped launch True Ventures, and he also had like an incubator called like Milk something in San Francisco.
Yeah,
Sorry, Kevin,
right.
if I'm getting this wrong. Also known as an amazing raccoon thrower. If you've ever seen the video on his Nest Cam,
Yes.
do you know what I'm talking about?
Yeah.
I just brought that one out of nowhere. Yeah.
Wow.
Probably best known as being Tim Ferriss' sidekick on the Tim Ferriss podcast. I was trying to say that with a straight face. I hope somehow somebody sees this that knows Kevin out of our 5 fans that sends it to him, and so he can get known as Tim Ferriss' sidekick just to piss him off. I thought that was hilarious. But anyway, Kevin, OG in the space, and then recently, really got obsessed with crypto and particularly NFTs, and he launched Modern Finance and Proof podcasts, and really, I mean, the exponential growth. I think they were well over 150, 200,000, listener downloads per podcast. And so he started thinking about, using all of his skill set he's developed over the last few decades, how would he like to participate in the space? So part of their Proof Collective is they launched a, what would you call it, like the card NFTs? They're not like fungible, but they're not non-fungible. They're more like a card system. So they are an NFT, but like if it's just that individual card that's numbered, but they're all the same card. Do we have a name for like?
It's a different. I know exactly what you're talking about. Where like everyone owns an identical NFT, but there's only a limited number of them.
Yeah.
It's a different EIP. I don't know, 1559 or something like that. It's a different type of token.
So the idea with their Proof Collective in launching those cards was, I think there was 1,000 of them, and it gave people access to their Discord channel, but also gave them access to their deep dive analysis of new NFT projects. So it was highly valuable for a lot of people. And I want to say they did Dutch auction. If my memory serves me, it started at 5 ETH initially and went all the way down to like 1 ETH before it sold out, right? And those were the original. And then now I think they're the equivalent of like 30, 40, something.
They 50 were up to like 37, 38 last night. I think I saw this morning they were down to 32, 33 of the floor value.
For Proof or for Moonbirds?
Moonbirds. Sorry.
So what I'm starting with is you had the Proof Collective, where it got you access to this card. That was only 1,000 people, right? And then part of that was you got access to the Discord. You also got access to their newsletter. And I want to say it's at an equivalent of like 150,000 last time I heard. That was maybe a few weeks ago. And then the idea was that gave an access point. Then he launched Grailed, which was a really cool, or Grails, which was a really cool project where they had like 20 art projects, but you didn't know who the artist was. So you had to like buy and like it just based on the art. And then after they minted them everything, they let you know who the artist was. And they had like the top like 5 artists in the entire NFT space and other celebrities and everything. So that was kind of just a fun, interesting project. And then most recently they launched Moonbirds. And Moonbirds is kind of the idea based on like Bored Ape Yacht Club. It was kind of like you got a PFP, but also you own the IP if you wanted to do anything with it. But they also airdropped, I believe it was 2 of the Moonbirds per Proof card owner. So part of owning Proof card was you got 2 free Moonbirds. And I think once again they wanted to do a Dutch auction starting at like 2.5 ETH, but the desire and the demand was overwhelming. So I think they just sold all like 10,000 at 2.5 ETH. And so that's roughly $75 million somewhere in that range on the initial mint. But since then, about a week ago, they've had the secondary selling. I think the total revenue is like 288 million. It was probably much higher. That's when I looked at like 2 days ago. But part of it is they programmed a royalty in there of 7.5%. So all of those follow-on sales mean that 7.5% at the higher prices goes back to that Proof Collective. and the Moonbirds. And so it helps them for building out, like Corey's saying, like you're raising money up front to then go and build the product, which is, the reverse of the way people usually think about things. But the other really interesting key piece to Moonbirds, and by the way, I don't know if this is true, but I think Kevin said that none of the founders like took a bag on the initial mint, that they're only paying, like Kevin said, he's only paying himself $50K a year. So he didn't like, put a couple $1,000,000 in his pocket or anything like that and put the rest into the business. He's putting it all back into the business. And obviously the top, the C-suite executives there have all had like massive exits. I want to say one of the other guys worked at Treehouse. Forgive me for not remembering his name. But what I thought was also interesting is they're trying to break new ground with ideas around nesting, is what they call it with their Moonbirds. And the idea is like you get rewarded for the longer time you've held a Moonbird. So they have almost like a pseudo staking program where you almost agree to lock up or not sell your Moonbird. And then that helps you gain these staking rewards over time. And then when they release new projects or airdrop new projects, you get more of that due to your ability to lock up your token, saying, I want to be in this for the long term. Because what Kevin said, what drove him nuts was like what you went through with like Mutant Apes or Bored Apes, is if you own Bored Apes from the beginning for years, and then you have the airdrop of like ApeCoin, and you got the same amount as if you had just bought a Bored Ape or a Mutant Ape the night before, you're not rewarding people that have been in a part of your community for years. And that was what was driving Kevin nuts. And this is why he added nesting to what they did. And I think that's another just step forward on how we're creating these more robust communities. And I just thought that was an interesting part of the project. I'm curious, you have any general thought? Oh, the other thing on Moonbirds I thought was fascinating is, they have different attributes. And based on those attributes, they're saying in future, they plan on like sending different gifts to those people with those attributes. So in real life, like if your attribute had like a space helmet on it, they're going to get like tickets to go tour NASA for those people. Or like if your Moonbird had a hoodie on it, they're going to send you a physical hoodie in the mail. Or like eventually they're going to send each individual NFT holder stickers, like 200 stickers with like their icon on it, or send glitch art to the ones with glitches. So it's just, once again, it's somebody, I think that because he's been so good at product over the years, it's somebody really thinking through this roadmap in a very unique way. But he's also, he gives the hat tip to Bored Ape Yacht Club that really gave the impetus for him to think about this in a more community centric focus.
There's so much to unpack here. I'm gonna try to be brief on a couple of points. I was taking notes there. So first, I believe I said EIP 1551 was the standard for the proof card that you were talking about. That is 100% wrong. EIP is a phrase my brother and I use. It means exercise-induced puking. What I really meant to say was ERC 1155. So thank you to the comments for correcting me on that one.
Exercise-induced puking. I feel like now the episode shifted. We need to talk about that for the rest of the episode.
Yeah, EIP, a good old EIP. Okay. Second, so you were talking about the value of the proof cards. They're now up to 144 ETH, which in today's ETH value is somewhere around $425 to $440,000 per card. Yeah, look, there's two things I sort of want to talk about here. One is, I mean, look, there's these amazing community aspects that's growing out of these NFTs, and it seems insane to look at a picture of a pixelated bird, an owl, and say this is worth $100,000. The same way I look at a mutant ape and think the same thing. But when you consider that you're no longer just talking about the ownership of a picture, but the community aspect, and knowing that there is going to be future real world and digital world assets that will be airdropped or transferred to you, or you will have privilege of being first owner of, that you can potentially flip, all of a sudden you start to try to do like almost a discounted cash flow and say, well, this thing actually might be worth something. So as an example, Mutant Apes and Bored Apes got airdropped ape tokens that when they priced and went live were probably an equivalent to a 20% dividend yield. Well, all of a sudden, is it outrageous to say if I think that a mutant ape is going to give me a 10 to 20% dividend yield over the next decade, and it's going to be, or over the next several years, and it's going to be, I don't know, $10,000? Well, why wouldn't this NFT be worth 100? Right? Like, you start to try to back out. Now, it might not be a traditional cash giveaway, but you might get ape token, and you might get digital land that you can resell. You might get an event ticket like with VFriends that you can resell. So again, it's what is the value of these assets that you are now going to get access to because you're a community member, and how do you do a discounted cash flow analysis there? I think that's people who are saying they're just JPEGs are missing that piece of it, that they're moving far beyond that, and there actually is a discounted cash flow value to them.
Just let me interrupt you for 1 second. I do think that so far the best use case is the event ticket, and shout out, what would be remiss if I say shout out for Blockworks for the permies and everything. And so, like you said, similar to VFriends, and then Proof Collective is saying same thing, that in the future they're going to have events with thousands of people, and once again your NFT is your ticket to the event, and then makes it much more collectible for people. And I think what Blockworks did with permies is another step forward in basically having that animated, almost like 3D feel to the actual NFT as well.
So a quick question from the comments was, what is an airdrop? So I think one of the most unique aspects, right, of the blockchain is that you have very transparent ownership. You know exactly which wallets own which tokens. And so it's very easy for me to go to the blockchain and say, tell me all the people that own a Bored Ape Yacht Club NFT at this point in time. And then what I can do is, knowing their wallet addresses, I can actually just send them things. It's a very interesting anonymous and permissionless sort of shared knowledge database of who owns what. And so what happens in certain cases, they take what's called a snapshot. They'll say, on this date, these were the wallets that owned these NFTs that we care about, and we are going to gift them something, or they can come to our website and they are whitelisted to claim something and pay the gas fees. And that's what an airdrop effectively means. And so someone like Yuga Labs is known for now airdropping, whether it's other NFTs or ApeCoin or speculation about digital land that's coming out. They're giving this to their NFT holders, which in theory gives the NFT some sort of cash flow value in US dollars. I do want to talk about one of the funniest things I saw in the last couple of days as it relates to these Moonbirds, right? Which have been the hot NFT. This is going to be a whole episode about NFTs. People are going to hate us.
I know. I was just thinking, I was like, we got this whole list of like ideas we had. It's going to be all NFTs for sure.
But I want to talk about this because this was really funny. So I talked about these two different platforms, OpenSea and LooksRare. And one of the main differences on these platforms is that LooksRare allows you to do what's called a collection bid. So what that means is I can say, look, I want to buy a Moonbird. I'm willing to pay 30 ETH, and I don't care what Moonbird I buy. Versus on OpenSea, I would have to go to every single Moonbird and put in a 30 ETH bid, which is expensive both from a time and gas perspective. It's just it's annoying. And so there's this idea of a community bid. Well, it looks like what happened is someone either did a fat finger and meant to put in 24 and put in 240 as a community bid, or someone else, or they meant to not do a community bid. They meant to bid 240 ETH on a very specific Moonbird. But what basically happened is this community bid for 240 ETH happened. Well, there was someone who was running, it looks like basically an arbitrage bot that was scanning the listings, and they saw this 240 ETH bid come up. And what they did is they immediately took a flash loan for 40 ETH, bought a Moonbird, immediately flipped it for 240, and then paid back the loan, netting themselves basically 200 ETH. Now, to do this atomically, they had to pay a node validator basically to package that all together and make sure it didn't get disaggregated and basically make sure it got in the mempool. So they didn't walk away with the full 200, but either way, they walked away with an enormous amount of ETH in like this instantaneous arbitrage that happens. And to me, I think it's, I mean, obviously someone really messed up there. There's no that someone fucked up badly putting in that 240 ETH bid, and they're very sad today. But I don't know. There's something about that mix between technology and that finance aspect that I just find so fascinating and so incredibly cool to watch happen, in real time.
But somebody's obviously prepped for that. Like you said, like we were talking about this, the Wild West. And so part of it is, rug pulls or contract bugs or fat finger mistakes. And so we've seen a million times, and you point them out a lot on Twitter, is there's a lot of fat finger mistakes when people are putting the wrong price for NFTs, especially on the floor, they get swooped up initially. So somebody had already coded up their flash loan just waiting for that to happen. And so
yeah, I mean, I was thinking to myself, that would be an interesting experiment to try to code one of those up. I do know hedge funds that used to do those types of trades with CryptoPunks. I had one on my podcast, MGNR, and they just basically said the strategy is non-scalable at this point for this type of assets they have. But if you're an individual, that would make a huge impact. I would love to have $1 million payday if it happens, if you get lucky once a year, right? Like, who's saying no to that?
Seems like it's worth the work,
right?
Worth the effort.
And then I'm not sure, it's probably a speed game at a certain point to be the first one to recognize it and be able to bribe the miners enough to get you in the mempool and get it all packaged atomically. But then you got to pay massive gas fees. I'm not sure. I don't think you have to pay the gas fees if you fail, if you do it through Flashbots. But I'm sure at this point, I don't know. I'm sure there's people in the chat that are cringing. Maybe to do that, you have to run your own node at this point to be competitive in the game.
I was just thinking how we usually get dragged for all of our TradFi dilettantish, opinions, and now the crypto side is just dragging us for all of our.
We're trying to make enemies with everyone. But I do so.
We're trying to cross the bridge somehow.
There's two things. There's two directions I want to take this. So I sent you. I think I sent you a WhatsApp message early in the week, with a tweet from Kobe. He goes by just Kobe in the world of crypto on Twitter.
Nice.
And I thought he wrote a great article where he was talking about some of these incentive programs, right? And so Bored Apes got these ape coins, and there's their governance token, and right now there's a big governance debate as to whether you should be able to stake ape coin to make more ape coin. And Kobe's ultimate point was that sort of misses the whole idea of what these tokens should be used for. Like, there should be utility. And if your only utility is to stake to make more, and there's no utility at the end of the day, like, it's ultimately going nowhere. It's spinning its wheels to go nowhere. Versus what Looks Rare is doing, which is trying to buy liquidity, get people to trade on their platform, has true economic value to the Looks Rare network, versus staking ApeCoin to make more ApeCoin has no value other than to drain the treasury, right? And I think that's a really thoughtful and interesting distinction between the way a lot of these programs or protocols are managing their tokenomics.
Well, most of them, that's what you're saying, are draining the treasury to try to incentivize network effects. But don't you think utility is coming? We're headed there. It's just trying to figure it all out. And I think that you and I talk about all the time is how do you cross it over to maybe TradFi utility, but then you have Oracle problems. And so maybe, we're just not there yet with the technology. And eventually we'll get there. And especially if you can have maybe more real world yields to attach to. I mean, you can do it with DeFi. But that's maybe not the utility people are quite looking for. But once again, if that utility provides an economic incentive, I can't help myself but once again think it's a security. So that's always hard to how do you cross that chasm? But I do believe that once somebody has set up, some sort of project or DAO, et cetera, they can always just pay to create a securitized token. It's just, are you willing to go through that process and deal with the lawyers to make it a securitized offering? And I think that's probably the next step, is you're going to see a lot of securitized utility tokens come out with both on-chain and off-chain asset classes that can provide much more income streams and utility on the back end. Is that fair? Do you think I'm off base? Jason,
I have never read comments. Normally it's the comments after the video that are angry with us. These live comments right now. First, I love this one. In a world that's literally burning down, we spend the smartest people's brain on this shit. Jeez. Well, let me tell you right now, at least Jason and I are not smart people. So we're not wasting any brain power.
No, I think they're talking about the crypto, the brain drain going into crypto. Yeah, they weren't talking about
crypto.
Us. I'm sure.
I know. Yeah, as long as you're not referring to us, we're losing there's no.
And this is why we talked about beforehand. It's really hard to not read the comments, but if we do read the comments, we get thrown off and we stop listening to each other.
Well, but it does make life pretty hilarious. So yeah. I mean, look, I think again the point here is using the tokenomics to try to incentivize economic value to a platform makes sense, right? Using tokenomics simply to create more tokens out of thin air that people can then sell when the tokens aren't being used for anything is just Ponzi-nomics, right? And it's an important distinction. And there's a lot of greedy players in crypto that just want to do the Ponzi-nomics so they can dump and extract maximum value for themselves when it's not necessarily the best thing for the project long term. So I look at something like, again, LooksRare, who's doing a massive incentive program right now. They are spending a huge amount of money every day to try to get people to list their NFTs, because ultimately, if they list their NFTs and the NFTs sell on LooksRare, that is profit that LooksRare makes because they earn, I think it's 2% of every listing. So it's valuable to the platform long term if they can incentivize people to be there. I do want to talk about that incentive, though, if you'll give me another minute, because it ties back to traditional finance.
Yeah.
So the way this incentive is basically working is if you happen to own an NFT in one of the sort of top volume projects right now, so a Moonbird or a Bored Ape or a Mutant Ape, and there's 20 of them that they list at any given time, and you list it for sale within 50% of the floor value of that project, then you start accumulating points throughout the day. And depending on how popular the project is, you accumulate more or less points or fewer points. At the end of the day, they take the total number of points you accumulated, divided by the total number of points accumulated across the ecosystem, multiply it by 250,000, and that's how many Looks tokens you get allocated. And Looks tokens are about $2 per token right now. So if I'm listing a not a Bored Ape, a Mutant Ape, I am making about $100 a day based on how many people are participating. Now, I want to think about that for a second. So let's use the math of the Mutant Apes are trading at a floor value of about $100,000. If I list it for sale at $150,000,
right,
in a way, it's sort of like selling a call option, right? Now sort of have this, like I sort of have a covered call. It's not exactly a covered call, but it's sort of like this resting ask is kind of like a covered call. And I am going to get paid $100 for that. Now, I only list it for a day at a time. So it expires after a day. So I can sort of think of it as like a 1 day to expiration covered call that's 50% out of the money. And I'm going to make $100 for it. So if you sort of like go through the Black-Scholes math, the implied volatility is 350%. Right. And so I'm thinking back to like, Ben Eifert, who's really popular on Twitter, saying, well, you don't sell covered calls for income. You don't sell covered calls for income. You need to take into account the implied volatility. And I'm sitting here going, if I list my NFT, is 350% annualized fair implied vol? These things can pump 50% in a day with the right event announcement. You never know what can happen with these. I think I'm doing it because I sit there and go, you know what? I'd be happy if someone paid $150,000 for this thing. I can walk away with that and be happy. And I'm also earning sort of a 10 bip premium per day for listing it.
So it is like a covered call, like you're saying about selling covered calls and figuring out your implied vol. But it's almost perfectly analogous, except for you're earning your premium on a daily basis. Like you said, you're earning 10 bips a day to just relist this every day to 50% premium.
Yeah.
I mean, that's fair. Like, and
by the way, if I stay on top of it intraday, if the floor starts moving, I can just move it up and pay gas fees, or I can just outright cancel it. And I won't earn the full 10 bips. I have to be involved all day for the full 10 bips, but I'll earn a proportional amount for the part of the day I was in. So it's like, it's this weird, it's not like a perfect equivalent to a covered call, but it's pretty similar with actually more optionality on my side.
Right. God, the way I would think about it, like you almost referenced earlier, creating a flash loan to take advantage of fat finger mistakes is maybe not at a granular capacity constrained level. Large funds aren't going to do it, but individuals can. And then like, just like you were saying, like this LooksRare project is, and getting that 10 bips a day, that's an opportunity you have right now that's likely to go away over time, right? As they incentivize more people, it's going to evaporate, right? It's almost like all of these ARBs eventually get ARBed away is what we'd say in TradFi. But what I think is kind of fascinating about it, and maybe I'm thinking too tangential about it, is you're incentivizing time. So like if you have free time to really deep dive into Discords and be on, covering the NFT space or buy NFTs and look for this covered call system, is like you're really incentivizing retail traders to spend their free time and monetize their free time. Like I think about, I used to count cards in Baccarat, and it was the worst way of spending time to make like $50 an hour and just, you know, shitty casinos surrounded by people you don't like, just, you know, mind-numbingly counting cards every day. So eventually you work your way up, but if you have free time, you can spend time doing that, right? So eventually we work our way up to the biggest casino in the world with TradFi markets. So I'm just wondering, like, in my sense of like, it's an ability to monetize free time. If you're younger and you have plenty of free time, you can jump on these projects, and people with larger asset bases and I hate to say it's age related, but like, let's just say older people with larger assets are not going to spend their free time trying to make 10 bips a day selling a covered call on LooksRare. But if you have that time, like, it's a very interesting way, like, to really build up an asset base based on your ability to have free time.
I agree and disagree. I agree in that it does definitely take time. I disagree in that, like, look, I don't have a lot of free time. If you get plugged in, if you work your way to get plugged in, you'll hear about this stuff. Like, it does, there is a learning curve. But once you sort of, like, I have a Twitter dashboard that keeps me very aligned with a lot of this stuff that's going on. So I can hear about it pretty early on. And I know people that are in the space. I think of it a lot about, like, there are these different protocols are trying to buy your liquidity. And if you are only long these assets, you're missing out on a tremendous amount of utilization of these assets that can make you money. And sometimes, though, you have to jump through loopholes. Like, I was long a bunch of ETH that I just have sitting there, just being long ETH. And, well, if I stake the ETH, I can earn an extra 4, 5, 6%. Okay, that's 4, 5, 6% that I wasn't going to earn if I didn't stake it. So I might as well stake it because I wasn't going to use it. But then it turns out if I take that staked ETH and I push it through the wormhole to go to the Terra Luna system, I can then use it to borrow their equivalent of a stable coin. And then if I lend that stable coin, I borrow it at a 5% rate, and I can lend it out at a 20% rate. So, like, to truly maximize the utility of these crypto assets, like, yeah, you do have to be a little bit plugged into what's going on in DeFi, and sometimes you have to jump through some hoops. But there is, like, an incredible amount of yield that can be earned, at least compared to the traditional finance world, in these assets. And a lot of it, yes, there is credit risk and protocol hacks and all that sort of stuff. But the vast majority of it, as far as I can tell, is coming from people are just trying to buy your liquidity and having you on the program, because the network effects are ultimately going to govern who are the winners and who are the losers in crypto.
Yeah, just to reiterate, you have a lot of overarching risks. So, play accordingly and position size the aggregate position of all your crypto across all of your asset class.
Yeah.
Appropriately.
I expect to lose all of this, to be clear.
But there was two things you said, though. You said people have free time, but I will let people in behind the curtain, if you will. Is Corey is unusual. He is one of one. He can put in a Herculean amount of work across multiple different platforms at any given time. So thinking you can do what Corey does on a daily basis, I know I can't do it. So and that's just an excuse on my part, because I lack the energy. And it's maybe because I'm a decade older, so maybe I'm losing energy. But part of it, like you alluded to, is like you're in these private chat groups that help you kind of see which projects are vet projects in a much more time efficient manner. So I was just wondering, like, if you weren't Corey Hoffstein and you didn't mind a little bit of grift, I was thinking while we were talking about all this, I think the way to do it is, like, even though things exist like Flamingo DAO, where they basically aggregate a bunch of people to buy NFT projects, and I think at this point they hold over $1 billion value of NFTs. But you could buy into the Proof Collective, get access to their Discord and all their research to figure out a time efficient way to figure out the best NFT projects. Then you could spin up a DAO for, like, you and your friends to aggregate a bunch of capital, and then you can buy into those NFT projects from that Proof Discord. Do you think that's a nice hack to maybe bridge the gap between TradFi and NFT land?
Yeah, except to buy into the Proof Discord right now to get
right,
to
but
the official one, it's
$450,000. Is it worth it?
It's hard for me to say that's worth it.
If you get access to the best NFT projects that way, like, is it worth it?
I mean, you have to have a lot of capital you're willing to put at risk, right? There's almost no way to hedge that. That's the hard part about crypto is, like, I've got a mutant ape that is trading at $100,000, which is ridiculous, and I can justify it and I can't justify it. But I'm thinking about ways in which I can delta hedge it, and it's really hard to do with something like an NFT. You can try to figure out the correlation to different tokens. I know that there's ApeCoin, there's a moderate correlation, but there's still a basis risk there that if I short Ape perps and I'm long a mutant, I'm not really hedged one for one. So there's all sorts of difficult ways. And I struggle to see, unless you have a tremendous amount of capital, an individual spending $450,000 on a illiquid NFT, that probably the floor is, the bids that they could take, the resting order book would be 10-20% below that.
No,
And
I'm
these
saying,
things
what
can
if
move.
Yeah, what if you had, a group of fairly wealthy friends, and or you had a large following of a few, tens of thousands of people, and you spun up a DAO that could raise at least 10 million bucks or maybe tens of millions of dollars, and then part of your alpha is then doing things like Proof Collective at 400,000 to get more time efficient way of vetting NFT projects. That's
Okay, so maybe I misunderstood. So you get,
yeah,
I don't know, 40 of your closest friends, you each put in $10,000. You buy one Proof Collective thing among
correct.
you. You put one of you in the Discord and you
Yes.
just like pipe that all out.
Yeah.
Yeah, I mean, I guess you could if you had 40 friends you trust. All it takes is one ban from the Discord and it's kind of game over, right?
Yeah. No, I was just thinking, once again, it's almost like doing public math. I'm thinking while we're talking, so this is not well thought out. I'm just pulling it out of my ass as we're discussing.
I mean, it's hard for me to say, like, if you're interested in this space, how to get involved. I think I came from a very privileged position of, I had a decently high profile on Twitter. So when I started to get involved, there were a lot of crypto people who were very open to talking to me and discussing with me and inviting me into their chat rooms and that sort of stuff. I'm not sure, so for someone who didn't have a high profile going in, that they could as easily get there. But I also know a lot of the people I'm talking to started their crypto journey 2 years ago, and they just dove in head first. And I know that over the last 2 years, it's been a unique environment where most people couldn't work and they had the time and they had stimulus checks and all that sort of stuff. But I do think that if this is a space where you are interested, there's still very open arms people who are willing to, say, hey, come learn. We want to share what we're excited and passionate about. And I will also say, if you're a quant right now, or you're an engineer, like, I wouldn't shy away from this space. They're paying MEV developers. So like, think of that as like weird high frequency arbitrage type stuff. They're paying them north of $600,000. So if you're a quant who knows Rust or Go, or you can code Solidity, like, there are really high paying jobs for you, even if you're a fairly junior developer, that you couldn't even come close to in TradFi. And that circles way back to the beginning, which is, why am I trying to launch products that in a good year will make me $1 million when I could launch an NFT that makes me 30 million in a day?
Yeah.
And the answer is because I couldn't raise 30 million in a day.
Yeah.
But like, I would hope I could make, I don't know, 50,000.
I think it's fear though too. Like, I think you could raise more than you think. It's just always the unknown is fearful. Like, even Kevin Rose said it, like, building product and releasing product he's really good at, but the actual sales process was the most nerve-wracking for him, because it's like, what's going to happen when you actually go to launch the project. But there's a couple other things you said in there I want to pull on. And, let's even bookend when you're talking about free time. Like, once again, I don't understand people that say I don't have time, because you and I spent nights and weekends trying to figure this all out. But you got to be careful. As soon as you go down that crypto or NFT rabbit hole, pretty soon, like, you're not sleeping well either, because you're doing nights and weekends on this. But to come full circle, you were spending a lot of time in these NFT projects and trying to get in on mints, even if they were in the middle of the night. And then eventually you decided this isn't necessarily worth my free time. And so you basically consolidated all your NFT projects to buying a mutant ape, that you're saying, this is my proxy for the NFT space, so I minimize regret moving forward. Is that a fair characterization? Like, that's the way I think about that. Haven't really talked about. It's like, you did a lot of work, you decided it wasn't worth your time anymore, but you didn't want to regret not being part of the space, so you used mutant apes as a kind of a proxy position. Is that?
Yeah, that's spot on. I mean, last August, when NFTs really took off, I was flipping NFTs, I made a decent chunk of money. It was a really good, fun time. And then the game got harder and harder and harder, to the point that I said, I don't have an edge anymore. I'm not willing to put in the time to retain my edge. And so when it came sort of towards November, I wanted to sell some of the stuff I had to tax loss harvest, anything that was a loss, but I wanted to retain exposure to this space. And And a lot of people ask me like, why did I buy a mutant ape? I should point out back then a mutant ape was not $100,000. It was trading at 6 ETH when I bought. And I think Bored Apes were trading at 50 ETH. And so my thesis was sort of a couple fold. One, I wanted to consolidate my positions into one. I did like what Bored Apes were doing. I think brand value is important. I liked that Yuga Labs behind Bored Apes were very permissive with the intellectual property. They were looking to grow the brand. They seemed like they had a real roadmap. So in terms of like, if I wanted exposure to this space, it seemed like a good one to be involved in. And I was sort of gambling that Mutant Apes, while I think they're going to be a second-class citizen to Bored Apes in the entire sort of NFT ecosystem that Yuga is building, I didn't think it was like a 10-to-1 second-class citizen. I thought it would be like a 3-to-1 or a 4-to-1 second-class citizen. So I thought they were dramatically underpriced relative to Bored Apes. And so for me, it was okay, that's the one I'll buy. And I also was not about to pay 50 ETH for a Bored Ape.
Yeah, I know you
didn't.
Money. But I also want to bring up, you talked about hedging, and a lot of times, we're huge fans of hedging in traditional finance space, but like you don't necessarily need to hedge. Your best hedge at the end of the day is position sizing. So if you position sized appropriately for your overall assets, then you're just fine. You don't necessarily need to worry about hedge. And I know you're just fine.
Position sizing is hard with an NFT, man. Like, right. So, and this is something I think about a lot. Like, I can't really fractionalize my mutant ape. And again, it's trading at $100,000. Like, I oscillate wildly, and I go, this thing is absolutely worth $100,000. I just got a dividend that was worth $25,000. It's a picture of a mutated monkey, like, and there's no way. If I could, I would sell half of it, but I can't.
I'm saying your initial position size, though, too. Like that's what I'm saying. More. I mean, yeah, you have a high class problem now.
But it's not about initial position size, right? Because it's like that's the mentality of it's house money now. Every day you should wake up and say, is this the portfolio I want to own?
Yeah.
Would I enter this position today? And I'm not sure I would buy a mutant ape today at its current price, which tells me I should sell, but I also don't want zero exposure. And right now it's very binary.
Yeah, but they're starting to have loans against mutant apes and Bored Apes, so that's another way you could potentially hedge. And Jack, I'm sorry, Jack's in the background here as always, doing a great job. And I know we were trying to bring you on a lot earlier, but Jack, I know you've been looking at the comments more we have, and because Corey and I get so distracted by them because they're hilarious. But Jack, if you had any questions you thought were interesting from the comments, let's talk about them. I did see one of the comments was Google, check out Google, and I think today it's down like 4%.
Yeah.
Yeah.
Yeah, that's a little.
By the way, the market's only off 10% from its highs, I think. This year just feels very different than it's actually been.
Well, and 60/40 is, sold off more than S&P, so it's always it's a very interesting year. Sorry, Jack, what was most interesting for you in the comments?
Let's see. I don't know. A lot of people. I think this is such a new space that it's hard to understand it and formulate questions. So yeah, I don't know. You guys really stuck to crypto.
Yeah, we didn't. We're a little mad we got put in a macro channel, Jason especially. So I don't know if people saw that Blockworks split between macro and crypto, and we're in the macro channel. So from now on, this is going to be a crypto show until we get moved to the crypto channel.
This is my protest song.
Yeah,
this
Jason
is my protest
macro so much that this is going to become a pure macro. By the way, Jack, I noticed on Twitter someone called you when you were promoting the show on Twitter. Someone called you Captain Jack.
Mm-hmm.
Nice,
which I both like and also plan on staging a mutiny.
A mutiny fund, yeah. Well, Captain Jack, he's suing Amber Heard right now, and it's ugly.
Yeah. That is a crazy thing to follow if you've seen any of it. By the way, I did see in the questions, what are we drinking? Or at least me, I'm drinking. This is just water. But they designed it like an IPA, and I'm really holding it to camera here because this is an egregious show of like I want to get sponsored by Liquid Death so it can cover my water habit. But yeah, it's just sparkling water.
And I'm just drinking my 8th coffee of the day because coming back from that conference last week, I honestly I think I said this last week. I was pretty sure I caught COVID 1 through 19. Somehow miraculously don't have COVID. I think I caught every other disease known to man from being in Miami. So I'm in a tough recovery spot at the moment.
I got a question. It could be for either of you, which is, have you done any quantitative work on what liquidity cycles do to markets, such as during times of quantitative easing, the S&P is 3%. The annual return for S&P is higher a little bit, and when during quantitative tightening, it's lower. Or
hey, remember what I said about 2:59 and 59 seconds?
Yeah. Whoa, that was extreme. Is he going to be on there? Is that why?
I have no idea. Who knows with Corey?
Yeah.
To answer your question quickly, it's I think Corey and I have talked about this before, but one of the things is with any quantitative study, you want a large data set, and I'm not sure you have a large data. Like you have basically 2 instances to go off of, and then so now you have and the plural of the anecdote is not data.
Yeah. Okay. I was worried. I'm like, Corey, are you a guest on this show? What you've got duties to the pirate ship.
So the question was studying liquidity cycles and impact on markets.
I'm glad now it's basically like you had headset on. You didn't get to hear my answer, so I can't wait to hear your answer.
I actually think this is one of those cases of small data problems in finance, which is did Jason say the exact same thing?
Yeah.
Did you use those exact same words?
I was like, you got 2 data points for one set of QE and one set of QT, and a plural of anecdote is not data, so there's no data to run.
You get one set of QT. You have more instances of QE. You've got like 5. But
so for those listening afterwards and not watching the video, I legitimately just left the chat for that entire time Jason was talking. So I had no idea what he just said. Look, I had a conversation with a quantitative fixed income manager, head of research for a firm in England today, and his view on a lot of this stuff was in finance in particular, when it comes to the macro, it is ultimately a small data problem, and no amount of back testing can inform you. It has to be hypothesis driven as to your understanding of how the mechanics should work from an economic perspective, and hopefully you can go back and try to tease out, like if you isolate those mechanics, figure out ways to try to find evidence that your hypothesis is right or wrong. But ultimately, you can't just run a back test. Like a back test is never proof or disproof of something being true. It's just one, version of history. All you're doing is sort of looking at how the market did sort of ultimately manifest, not all the ways it could have manifested.
Corey, along those lines, I actually was just having a conversation with PJ Pierre at Denali the other day about the idea of curve fitting and backtesting and everything. Is like, but at the end of the day, every backtest we've ever done is essentially curve fit in a psychological sense. It's like, so do you admit to yourself that if you're really honest, you're going to say this is curve fit, but I try to curve fit it less than anything else I did, and then you always have this interesting conundrum of like, in sample, out of sample, and then real world are always 3 vastly different things, and no matter how much you try to not curve fit.
Yeah, curve fitting's a really hard one because it's hard to erase your memory of what happened. I think ultimately the best research teams I know try to get in a room and come up with a hypothesis and come up with all their reasons for why the hypothesis should be true. And again, a back test is never about did something perform well or not perform well. It's did it support or not support the original hypothesis as it was laid out. And ideally that hypothesis, at least for longer term signals, alpha signals, tends to be tied to some sort of economic rationale. Renaissance and what they're doing, totally different, right? Totally different type of alpha. High frequency trading, totally different type of alpha. But for the more medium and long-term alpha signals, I think there's that tie to economic rationale, either from what's happening in market participants or what's happening in the real economy.
But also you have like even like QE example or whatever is like you have one, you need to get clean data, as you know, and then you have to think about the data set based on the market regime you were in. Is there anything outside that market regime that didn't happen during even the 20 to 40 year back test? The one that always messes with my mind is like, and not to get too out of left field here, is like if we think from like 1870 to now, from the advent of the industrial age, especially like in America, globally, we went from 1 billion people in the workforce to 5 billion. Over basically the 20th century. And so anytime anybody tries to even show me an S&P 500 backtest, for the last 150 years and what the returns would be, I'm like, that just doesn't count. Like we cannot go exponential on the workforce again. We're going to add incremental improvements, maybe upwards of 50% by the time we hit allegedly peak population in 2070. So even a 150 year backtest for me is like one data point if you take a really broad view of the advent of the Industrial Revolution and the rise of the workforce during an exponential era.
So Mike Harris in the chat says backtests are for rejecting, not accepting a hypothesis. And he's right. Any hypothesis-driven approach, I think you need to keep that in mind, that you are rejecting or you're not rejecting. You are never accepting. And I think that's a really important part of scientific design. Yeah, Jason, I think one of the things I'm seeing now left and right is how do markets do in inflation? And right, we go back to that one data point in the 70s and 80s.
Yeah.
And the thing I never see anyone addressing is the composition of the market was completely different back then. The role of central banks was completely different back then. The sector composition, the globalization of the world was completely different back then. How that one data point could even be relevant unless you go to the true fundamentals of how does inflation impact cash flow and try to work it out backwards and then see if your model actually played out the way the 70s did, can be then maybe a way of saying, okay, I think my model is a pseudo fit to the world. But you don't go back to the 70s and say stocks did well or didn't do well, and therefore they will or not do well with inflation going forward. You're missing the driver. And I think that's the key point here is if you're going to do that type of analysis, it should be more about seeing if your toy model of the world is potentially representative of how the world plays out.
What's even worse is people go, history doesn't repeat itself, but it rhymes. And I'm like, why? They say things like that, and it's like, okay, we're talking about like a haiku versus Homer. Like, what are you talking about? Like, you're still using the repetitive one. You're using analogs to project into the current times. And like you said, everything was different. All of your implicit assumptions are different. The market's entirely different. Like, yeah, it drives me crazy.
So I'm going to totally out of left field here. People who are listening won't see this, but Jason has a Pirates of Finance background now, and he's also wearing a Pirates of Finance hat. And I'm wondering if next week there will be also a Pirates of Finance shirt, whether the vase behind you will eventually get a Pirates of Finance sticker. How much of your screen real estate can get filled up with Pirates of Finance?
Well, as you
it's
know,
I'm laying down the challenge.
I'm testing out everything. I'm even testing blanks for merch maybe one day, just because I love expressing myself that way. Yeah, I'm like a realtor using their car, park benches, billboards. I'm trying to get those tax write-offs, Corey, from all those buckets and bucket loads of money we make off of here.
That's right. Hey, you know what we should do? We'll launch an NFT that you can use to redeem for swag. NFT will help us create the swag store. And if you're an NFT owner, you can redeem swag.
I got another question, and there definitely is a lot more data for this, which is what about pricing in like rising in short-term yields in expectations of a hiking cycle. So for example, 6 months ago, the Fed funds terminal rate was something like, 1%. I'm making that up. Now it's like 3.5%. And that is, a tightening of monetary conditions that is very measurable. What do equity returns look like during those periods? Yeah, Corey.
I think if I'm understanding you correctly, you're talking about what do equity returns look like during periods of forecasted increased Fed fund rates?
Yes.
So there's sort of two important things to consider here. The first is it depends, at least historically, and the numbers, and I think, again, for all the caveats we just said, it's kind of garbage. It depends on why are we forecasting higher interest rates. Are you forecasting higher interest rates because the economy is running hot? Well, then equities tend to do pretty well. Are you forecasting higher interest rates because there's a crazy inflation spiral? Well, and again, I think it depends upon the magnitude of that forecast. I think the other thing to consider is a lot of these forecasts are derived from derivatives markets. And derivatives markets are priced in what we would call a risk-neutral probability, not a real-world probability. So when you take all these derivatives markets and you basically back out the implied distribution of how the options market might be saying stocks might move, or how the Fed funds futures are saying Fed funds might be priced. I think what's worth considering is that people may buy and sell those Fed fund futures for a reason that has nothing to do with their forecast or believing the price is right or wrong, and it may just have to do with hedging risks beyond a certain point. And so it's a little difficult to always look at those markets and try to back out an expectation because it's not based in a real world probability.
That makes sense. Yeah, like people would they would buy December, they buy 2024 Eurodollar calls and then people look at the curve and then they see an inverted euro-dollar curve and they say the curve is telling you a recession is coming because there's an inversion of like 3 basis points. But it could just be people are buying that as a hedge for equities because
Right. Yeah, exactly. Jason is shaking his head. He doesn't like the fact that we're talking about macro and getting the show
Jason,
back
too
in the
bad.
macro channel.
No, I was actually
Jack, if
thinking
you
about
don't
this
ask
morning.
a crypto question soon, Jason's going to be really upset.
I was thinking about this morning. Jack tipped his hand with calling his show Forward Guidance. It just shows his deep love for the Fed, and that's why he always wants to bring every question back to the Fed. And by the way, I did see in the comments from Gregory giving a shout out from Suriname watching the show. Like, that is incredible to me.
That's great.
It's awesome.
But it is Captain Jack trying to steer a mutinous crew back in the direction we're supposed to be going.
Back to TradFi. I reject the TradFi.
Jason, I'll give you a TradFi question, but it's red meat for you, okay?
Sure.
Doom and gloom sells. Go.
Oh Jesus. You're not gonna like where this goes. I was thinking about two competing factors right now in what I think in narrative space. One being that, everybody seems to be, BTFD, buy the fucking dip, is like all of everything coming out these days. Even when like the Russians invaded the Ukraine, everybody was showing every time there's an invasion, you should buy the dip. And so like all of the literature coming out right now is still like buy the dip. And even with the tech stock sell-offs, or what you want to call meme stocks or COVID stock sell-offs, like everybody's like buy the dip. And it's just interesting like how this narrative keeps going through until it doesn't. So that's one side of the character. And then historically, just thinking a lot about, how doom and gloom sells, and everybody loves doom and gloom. And, we even started our first post in our WhatsApp thread. I think I posted that, pessimists sound smart, but optimists make money. And right, life's not that simple, but it's interesting to me because I was just going through actually, we're always kind of searching out, the competition, or not competition, but like, what does the rest of the financial show space look like across YouTube, social media, et cetera. And it is fascinating to me how just doom and gloom sells. And quite frankly, like Jack, like even, Blockworks is to blame for this too. Like all the titles are about like the world is ending, bonds are crashing. Like, what are we going to do? And like this clickbait title system, I mean, it's obvious and I understand why people do it, but it's just like, if it bleeds, it leads. And it's just become so pervasive in finance. We haven't even been here a quarter.
Yeah. Okay. So Pirates of Finance is now, I guess, looking for a new home because we've been fired by Blockworks.
I'm just, I'm trying to get like, I may be I don't even know what I am, a middle-aged man, but I'm trying to just get to old man yell at clouds like stage as fast as possible.
Yeah. Jason, I realize I'm obviously incredibly biased, but I am a defendant of Blockworks content. I think that the titles are definitely titled in a way to get people to click on them, but once they do click on them, like I think the sensationalism stops absolutely there. And yeah, I don't know, like, I recently interviewed like Mike Howell, and he talking about liquidity, and the thesis would be, I would say, doom and gloom, that he's done some back testing on when liquidity is slowing in the market, and he doesn't just look at central banks, which, as you say, is a very small number of back tests, but like cross-border flows in the private market, as well as just financial conditions and stuff. And it's not looking good. And I would not have someone on my podcast who has said that for the past 2 years and been wrong, and now might finally at last be right. Like, Michael Howell, I was just watching some interviews that he did in April and May of 2020, and like he was kind of getting booed because he was bullish. Do you know what I mean? Because everyone there was so bearish. So I feel like, and he kind of, popularized the term global liquidity, and really was. I think he's definitely a force to be reckoned with. And
but
yeah,
I agree on that front. But you should be careful if you tell me I don't have people that do that, because now I'm going to go through all of your interviews to find all the perma bears that have been perma bears for a decade. But no, Corey, let me finish. Sorry. And in fairness, I do get it. It's like the Tim Ferriss quote: you need to use the PT Barnum to get in the door, but then you provide real value on the back end. And that's what you're saying Blockworks does. And I agree. What I'm trying to actually get at, and maybe I'm just making excuses for myself and Corey, I don't want to lump you in here, is the idea of just in our space in general is either irrational optimism sells or doom and gloom sells. And there's not like an option C for like a rational optimist like Corey and I, and like the nuance of what we do. And so I'm always worried, like, does that mean we're always going to have a smaller audience, which I'm fine with. It's just trying to look at the state of play and lay of the land and just be realistic about it. Sorry, Corey. Go.
No, I mean, I think I was going to come to Blockworks' defense. I think if you look at the landscape, the reality is, as much as we all hate clickbait, people click on clickbait, right? It's sort of like it's the same thing we see in the world of finance, which is if you try to take the high road and not sell a backtest, you're going to be up against competitors who are selling backtests, and you will lose business. And you might be right in the long run, but you won't stay in business. And there's this sort of forced bad behavior unless we can regulate away the bad behavior. And I hate to say, like, you just have to play the game, but sometimes you just have to play the game. And the game right now is you need a clickbait headline. Until you can sort of prove the quality over time that keeps bringing people back, you just have to do the clickbait. And, that's where I sort of take I put my business hat on and I say, that's just part of business. I may not like it, but that's the game. And to just if you want to play the game, you got to play the game as it's being played.
And in fairness to Blockworks, they're the kind of company that can deal with me, asking these kind of questions. So that's the other reason why we love Blockworks, is because, like, you're not allowed to just only say positive things about the company. And I don't think I said anything negative. I'm just pointing out some interesting, when I was just scrolling through YouTube, this is what I found. And sorry, Jack, you were going to say, or did you just take so many notes you had to flip the page? Are we that interesting?
No. I was going to say that, Corey, I'm not in the investment business, so the simple version in my business is not selling a backtest, but like just selling a chart and having two lines cross and saying, like, when the black line crosses the red line, watch out. You know what I mean?
We didn't do our new part of the show.
Which is what?
Which is going to be Chart Crime of the Week.
Oh, yes.
We've got it.
Okay,
for everyone who's still tuned
week.
In, we're going to have a new recurring part of the show, because I get so mad at the charts that I see posted on Twitter that we're going to do Chart Crime of the Week. So, Jack, you got to hold us to that.
Okay, I will. Yeah. Anyway,
keep us on course, Captain
Jack. The red, the red line crosses the black line. Watch out. But Jason, I was going to say, if I was going to criticize myself and the interviews I've done, not just at Blockworks, but like just all the interviews I've done, I would say that I don't push back on guests enough. Like, so it may seem, if someone watches an interview where someone's like, the economy is going to slow, the Fed's going to cause a recession, buy bonds. Like, first of all, I don't actually believe that. Well, I haven't over the past like 6 months. Like, I'm quite, just TLT is so low, yields are so high. I have a lot of questions now, but I'm saying, like, then I would not question them that much because I want them to look good and want them to look smart. You know what I mean? Because like, if I disagree with them or if I challenge them, like, why am I having them on my podcast? And then I might the next podcast I might have on someone who's like, yeah, the bond market route has only begun. Like,
yeah, I completely agree. It's not your job to argue with them. Your job is to let them steelman their argument, to highlight the good parts of their argument, and then if you disagree, bring somebody on the next time that disagrees and steelman their argument. Yeah, I couldn't agree more. It's not your job to argue with them. It's your job as an interviewee to make the interviewer look good. Interviewer, interviewee, I always forget those backwards. But yeah, I have no problem with that. And yeah, you try to steelman and make them look good, and then somebody disagrees, they can come on and they can have the steelman of the other side of the argument. It's just like I said, I was just thinking about the clickbaity titles of doom and gloom sells, right? And it's interesting. It's either like irrational optimism or doom and gloom. There's not like, the world's going to continue like it kind of always has. The inertia kind of repeats itself. That sort of thing is like the world is full of sound and fury in the end, kind of signifying nothing.
So where's the irrational optimism that sells? I agree that doom and gloom sells, but like, what's an example of
Tesla? Yeah,
sure.
Tesla. Yeah.
Sure.
Yeah. And Eric Balchunas at Bloomberg had a great session with Kathy Wood at the conference I was at. I didn't get to watch it live, but I caught some of the replays. And he asked her straight up about some of the forecasts they make, which are wildly bullish. And I think, everyone should go watch the replay for themselves to hear precisely what she says and not my version of what she says. But I think she very much admitted that to her, marketing was a very important part of getting the business off the ground. And I think they view wildly bullish calls as, if they're going to be inaccurate, they might as well be inaccurate and catch eyes, right? And it works, right? And when they publish long research pieces that seem massively inaccurate, people spend days ripping them apart on Twitter and giving them free marketing. And I think Kathy looks at it as all marketing is good marketing.
Yeah, and in fairness to her is like, I just don't understand. If you hate her and hate ARK, don't buy it, short it, do whatever you want. Like, but it's like, it's amazing to me, like how people like just, project all their fears, hopes, and dreams onto somebody and just want to tear them down. It's like, who really cares? This is why we have markets. You can bet for or against that opinion. So express it with money and maybe shut up about it.
So Jason, who is still like hating on ARK without shorting it? Like I feel like a lot, like all the people who have used to be hate on ARK and specifically Tesla, they either have given up or lost so much money,
Right.
or they actually have put on a position and they've positioned it well where they still are short and they don't have the need to talk about it. Like I feel like I hear way more like hype than I do.
Well,
hate,
ARK has come way back down to earth, right? I mean, I think
Yeah.
a lot of people
I mean,
who were anti-Kathy now sort of feel vindicated. I think it's
Right.
underperformed the Qs since launch. Now, even when it was outperforming the Qs, its tracking error is so large, I'm not even sure that was statistically significant. But yeah, I think a lot of people who are Kathy haters are now just less against what she buys necessarily and more against what she stands for, right? The type of business that she runs. And I think there's something to be said there. She runs a very particular type of marketing business in finance, and I think there's people in finance who the way she sells product goes against their ethics and morals. And I'll leave it at that. I'm not going to cast judgment, even though
This goes like full circle to like, why you want to like launch an NFT project or what business you're in. By the way, Metatram said I can't buy a manager that doesn't have lips. But I just realized he screwed me because I have no lips. I especially have no upper lip. This is my beard is to hide my lack of lippage, especially on the upper tier.
Wow.
So I just got kicked out of his search for managers.
okay.
I think that's a good place for us to end. I don't know how we recover.
That was a shocker. That was a real. I actually am speechless after that one. All right, Jack, do you have the outro queued up?
Oh, I've got the outro. Everyone.
Go
Go
sorry,
ahead.
Jack. Before you go, we ran out of time again. I think next time we'll talk about return stacking. We'll start at the
Yes.
top. We'll talk about Corey and Resolve and return stacking. But otherwise, speaking of Resolve, everybody jump over to watch Resolve Riffs with Chris Abdul-Masih. Should be a great show. We're really looking forward to it. And Jack gets so mad when we hype other shows, so I'll let Jack hype our own show.
Watch Pirates of Finance, currently on Blockworks Macro, and if Jason keeps it up the way he's acting, he may get his wish. He may end up on Blockworks Crypto.
Or not
Okay.
on Blockworks at all.
Thanks so much, guys.